We have our, a general agenda of what we're going to talk about, but our firm is not in-depth in your field of financial analysis, planning, investments. Our backgrounds are in behavioral and communications research. Essentially, how does information affect attitudes and behavior? What are the catalysts that people accumulate over time that prompt them to action at some point, long-term, short-term, and particularly in the financial markets, maybe today or tomorrow. The earlier presentation, the one just before me, on the cover page, it had a quote from Keynes that the goal is to anticipate, that people are anticipating the anticipators. My quote's from a book by Robert Schiller that was largely about Keynes, who, yes, said the stock market is much like a beauty contest. Don't try to pick the prettiest girl, pick the girl that the judges think is the prettiest girl. And there's a lot of interest in this idea of, who's watching the watchers and how do you predict what's going on. So let me start with the conclusion of what I'm going to show you. Again, we developed a methodology, an information system. Again, it touches on the elements of big data, news, and how you turn this into measures of economically sensitive behavior. On the left-hand side is a summary of our sentiment indices, economic macro sentiment index, and an uncertainty index overlaid with the S&P. And the results are a simple application of those signals to the S&P over the last 5 years. And when we've presented people from the bottom up before of here is our data, our methodology, and here are the results, it would be, well, how did you get to this? So this is, we're going to show you is how we developed a methodology step by step. And like some people have mentioned before, we have a data set. We don't necessarily have an investment strategy. There's still expertise involved in applying this, other external variables. But in effect, this is a new type of data set that we believe can have a more universal application. What are the origins of macro sentiment? Many of you remember March of 2000 when the Barron's issue came out and said, the burn rate of all these companies means they're going to be out of money in the next 90 days, and the market crashed. 2008, something else happened. So people are concerned about, can you really forecast the black swans? Probably not. But we spend most of our time seeming to anticipate what's going to happen and then recovering from what did happen. So our goal was to find, not just ways to anticipate the big events, but all the opportunities that are in between. This is the challenge. This is what everybody here does every day. And the process was, if I could have known then what I know now, what would I have done differently? So the goal was, how can we work backwards from events, from information, and see how far back you can identify what George Soros likes to talk about as inflection points and act on those more quickly. So we set out, actually I started out in this couple of years after the 2000 dot-com implosion, is what would I need to do to learn in anticipation of what's going to happen. I had started doing internet research back in the late 90s, because the whole idea of the internet was it was going to change everything about research and sampling. For most of research history, the number one element was representative sampling, logical questions, and then do the analysis. But what's happened with the internet is the whole idea of sampling has changed. Now we can go back to observing what's happening, getting feedback in real time, and bring that back into the analytical system. So the idea of big data is very popular. It's not a very old statement, but I'm old enough to have lived through, it was called an avalanche of data, knowledge management, intellectual capital, single sourcing. There's always been more data than we can deal with. But what's happened in the last 10 years is the compression of time in which to use that data. We have more data, fewer analytical tools necessarily addressed to that data, and we have to use it quickly, preemptively. So the idea was, can we capture things as they are emerging in their original form, and basically, as someone mentioned before, can we have tomorrow's news today? And again, the internet has given us this gift of all the information we need, but it's definitely very well hidden in there. The other element is what can we do that's not being done now? Probably everybody today has talked about really the bottom-up company level, a lot of really good micro and analytics. Our goal, just because we understood overall consumer demand and consumer behavior, was what are the macro influences? Can we do a top-down? Because today, the consumers, the markets, and the company performance are intricately linked every day. And can we use that? And unstructured news, okay, nothing to explain there, it's been covered. So we tried to develop a more universal measure of economically sensitive behavior. We use it for sales forecasting, for digital media, and today we're going to talk about the financial markets. What's interesting that digital media and financial markets have in common, huge volumes of transactions, whether it's pay per click or other measures of digital media, immediate feedback on whether something is working, and how do I change the pricing or the decisions this afternoon, tomorrow, or next week. We chose the title Uncertainty because someone said to us a few years ago, if you guys can nail uncertainty, this would be really good. It's not what we set out to do, but we hear the words all the time. We know what uncertainty feels like. We think we know how to interpret it, but it's really, it's the all-encompassing term for what we don't know but wish we did have. And certainly since 2008, it's been the dominant psychology. An hour ago, I looked at my email, and there was a blog from somebody on Seeking Alpha. Expect more uncertainty related to the Fed. I mean, this is the answer to what everybody is trying to solve. How can I get around uncertainty? But if this is the big issue, I would say uncertainty is not what it used to be. When Columbus sailed off, that was really uncertain. He didn't know where he was going or if he was coming back. But today we use the word in a very loose fashion that a lot of things we don't know. But the reality, and if you can see this was from some survey in 2011, how do you assess the overall economy right now? And here's your word cloud, uncertain. It's a convenient mechanism for what we don't know, but it really refers to what should I believe, when could I know it, where can I get it? So, as they say, ripped from the headlines. Barron's, blame it on uncertainty. Warren Buffett said, tomorrow is always uncertain. The long-run trend is hugely important, but it takes years to recognize. I don't think anybody here has years to recognize the trends. One of my favorites, and this is from the Motley Fool, the past 5 years explained in headlines. I would not want to come back next year and say, here are more headlines since last year and what we learned from it. What everybody wants to know is what the headlines are going to be next week, next month, and 2 months. Not in 5 years, we can't do that. So I would say that if we go to the classic definition of uncertainty versus risk, all the definitions say risk has some known probabilities, uncertainty does not. But I no longer subscribe to that because we know what the situations are, we know what the tools are, we know who the players are, and the expectations they create. And the reality is that every single day, whether you feel uncertain or not, you have to make a decision. So in effect, we are managing uncertainty by our actions, the risks you take, whether you go long, short, or whatever. And all the information you saw today is are tools to manage uncertainty, even though it's still inherent in what you're trying to do. So this is not going to go away. It's going to become more pervasive because there's more data, it's coming faster, and the idea is how do we begin to harness that? So again, to set out a mechanism of what are we trying to solve for, there's short-term forecasts, people extrapolate from them. Near-term consensus, and one of the most common phrases you've all seen is something came in higher or lower than expected. How can we reduce that surprise? Official reports, whether it's retail sales, GDP, housing starts, these are all useful, we all look at them, but they're definitely lagging reports. A month, a quarter, they're revised, but they have impact when they come out. And then through the use of technology and firms like Ravenpack, you have actual market data. So we wanted to do two things. One, get the antecedent of what preceded these. And second, provide a context for them as we go along, because it's continually changing. This is the raw material of ingredients. There's been a lot of discussion today about either social media or sentiment attributed to a comment about a stock, and this is all true. We've taken it, I think, into a different approach to complement the more narrowly defined sentiment, but looking at complex text. We get an article, it could be 1,200 words, there could be 30 statements in there. The Fed is going to do this despite consumers' loss of confidence. However, the price of oil has dropped, but the IMF is taking these actions to support Greece. Collectively, what does that all mean? And if you can envision a situation where the Fed makes an announcement, that's one event. That event spawns hundreds of thousands of all kinds of communications issues that day, and then it's let's come back to a simple decision. What you do in the market, how you set your risk. But this is happening every hour. So how do you deal with this huge universe of concurrent information? It's contrarian, there's factuals, there's hypotheticals, there's what-ifs. So what we've tried to do is develop a system that consolidates all that into a net expression of leading sentiment. And this is basically a simplified graphic of what our predictive content analytics does. We have three overall issues we monitor. Overall economy, which is a very large Boolean search term for anything and everything you could read about the economy. Subgroups of housing construction and real estate, and recession recovery and economic strength. These are durable buckets of information. The language may change, but the issues remain. And since we started this actually in its current form in 2006, the lexicon has changed. We didn't start with Greek default or fiscal cliff. Polarity of information changes over time. When housing prices are going up at one time it was good, then housing prices going up was bad, now they're going up again, it's good. Same thing with the price of oil. So you have to look not just at the expression, but how it's related to it's being interpreted and implied. And we do it separately for the business media and the mass media because we found that each type of media has different types and duration of coverage, different real-life stories to forecasts. And these are changing on a weekly basis. And then we code this in our own proprietary coding system into positive, uncertain, and negative. I say we don't use neutral because we've tried a lot of automated systems and the answers come back. There's a whole large group of information that's neutral, but that's because it can't be classified. The fact is, what we see as neutral in one context is really has a lot of richness. This is one of the distinguishing features of how we treat sentiment. It's a lot of the early work I did was to harvest data, classify it, and then look to see where it's correlated. But what we did in this, essentially, this recipe was that if we have an information design from specific sourcing, continually adapt the language, and then code it in such a way that the outcome is inherently more highly correlated to the S&P or retail sales, that was our goal. Not to have a number in search of a correlation, but one that is by design has a recipe that's going to produce what your target is. And if it didn't produce that target, we wouldn't obviously be here today. So we take these 6 buckets of information, and the basic look at sentiment is on this chart. This is just taking one measure, the overall economy, showing positive, uncertain, and negative against the S&P. Our data began as crossover long before the S&P went down. It bottomed before it went up. But what's fascinating and worrisome is that the recovery, the way we measure it, is built totally on uncertainty. We've seen negatives and fear largely disappear. The positives, outright positives, have never come back in their full bloom because, number one, we're told it's uncertain every day. Second, There's too many different attitudes, the big data of issues. And we have other metrics that overlay sentiment with retail sales and housing starts that show certainly the recovery in housing was one of the propellants of everything getting back, but even that has tapered off a bit. So this was the first step, to develop a foundation of macro sentiment. And then we wanted to create leading indicators that could be used in other applications. And we tested it against hundreds of external variables. Some work better than others. Here's this one fundamental looking at our sentiment index against housing starts, S&P, and retail sales. And they all showed similar curves at different time frames in terms of when they crashed after 2008, when they started coming back. But you see at the very end, the S&P being the black line, it's continued to grow more recently, far faster than anything else. This gap is something to be monitored. It's those who call for a correction. The gap cannot keep widening without something happening. But the idea is, if it happens, how early can you get the warning signals? Maybe not the exact date, but at least an alert as to what's happening. So now we've got our foundation of sentiment. We wanted to create leading indicators that had specific benefits to those who are going to be using them. First, it has to lead conventional metrics. It has to lead consumer confidence. It has to lead UBS surveys or State Street Consumer Index or many others out there. So you need something to give you some preemptive benefit. 1 week to 2 weeks to 4 weeks. Our data is not a 6-month program, but it's news. News has a cycle, 1 to 6 weeks. It's pushed aside by something else. It's got to be more highly correlated, and it has to have long-term effectiveness. It can't be a model built for conditions. And we do that by continually adaptive lexicon, bringing in new variables as they help increase the explanatory value. Just a quick look at one slice of the leading indicator in terms of how does it compare to retail sales, S&P, or SPX as we use it, and housing starts. And yes, it does lead these by anywhere from 2 weeks to 2 months at very high significant levels. With retail sales, it's kind of easy because it's definitely a lagging indicator just through the methodology. We did a study comparing our data to the University of Michigan about a year ago. We had talked to one client and suggested they take out Michigan data and plug ours in. And they said, we look at it, but we don't use it because it's not predictive. This gets back to the idea of sampling. There's a lot of robust sampling of people, but not necessarily robust sampling of data, which is where we focused on. A representative sample of data that has maximum differentiation and minimum redundancy in order to separate the noise from what the insights are. So once we got on the track of the leading indicators, we said we want to start building up for specific applications. And this is what we did for the financial markets. We start with the biweekly macro sentiment. We actually capture it daily. We roll it up weekly and biweekly. But for most of our history, we used biweekly, and we changed that, and I'll cover that in a moment. Then we looked at the economic environment influences. What variables do we add in periodically that add explanatory variable to the leading indicator? And third, which was a years-long quest, is there a third set of market-driven data that gets us closer to the decision points? If all this information is out there and it's going to have an impact, how can we best measure that through market pricing? Ravenpack was, we contacted them, I think, last summer. We exchanged data sets and found that Ravenpack's data was the first one that added explanatory value to what's going on in the marketplace in conjunction with our data. We haven't looked at many others since, but in terms of whatever Ravenpack is doing, now we're not using the company level data. We roll it up to the S&P because we're not company level. It's a different kind of approach. It's the macro top down. So we're getting that and incorporating it in our leading indicator. Okay. I'm not going to get into detail here, but if you're looking for stability and correlation over time, these two charts our chief statistician says illustrate that. But to pinpoint where Ravenpack is helping us specifically, if we look at part partitioning the market into the size of changes in the market. When it went down 5 to 30%, the big middle, the relatively non-trending markets of minus to plus 5, and then the increases. We knew we had from other analyses some pretty good coverage of anticipating the big shifts, but what happens in the majority of the activity that's out there? So the use of Ravenpack data really had a big jump in terms both increasing the overall cumulative return, but specifically in this vast middle market where there's maybe more impact of companies and less of macro influences. So this was a significant jump in improvement. If you want to look at the actual cumulative annualized returns, comparing the S&P buy and hold, our basic sentiment indicator, which is the EESI, and then that with the market feedback via Ravenpack, this shows from 2010 through about the middle of February what the performance has been. We had talked also with Deltax Labs. They generously agreed to, they were intrigued enough with our data that they offered to test our data, and their results are on the side in terms of confirming what we were doing. So then he gets into, we have all this data, leading indicators, how do we create the actual macro sentiment signals? So we have an information system applied to market direction. Whatever we show you is not a judgmental, it's not an expert trading system. It's a simple application of almost mechanical systems that lead where the market is going to go. But as we've talked with asset managers, it's like, yes, I need excess returns over the benchmark. And then, we know you can make money in the highly volatile moments. How is this going to be applied to those situations? The basic thing we would deliver is on the bye week and then the mid-cycle is a signal that looks like this. We do it for 4 asset classes. This is really optimized for the S&P, but people want to know about other things that may or may not be correlated. We've looked at bonds. It doesn't work quite well. There's other approaches we're working on. It doesn't work for commodities. It's other types of things that have a different kind of construct with sentiment and macro influences. So we produce a signal that's both directional and it gives the strength. But there's a lot of information going on behind the scenes. We take the actual leading indicators and go through a multitude of statistical modeling processes to find consensus among different approaches of thresholds, momentum, weightings of the different components. And the goal is to find where you are finding the maximum information from your sets of data. There's an old science of information entropy, is that every piece of information you get has some value, but you have to find out what it is. And what's interesting, when I started the business, I called it TrendPointers because we were looking for trends. But as that article said earlier, trends take a long time to develop. So we're really dealing with is trajectories. Whether it's a golf ball or the space shuttle or what we see as volatility are really mini trajectories. It starts, it reaches a point, and then it lands somewhere. So we look at multiple models to look for consensus. They are not always in agreement. And when they're not in agreement, you look at the relative statistical strength of each model to make your decision. The simple process, like I said, we have used in our own testing. The few firms that are using our signals now are following this basic schedule. We get our news over a period of 2 weeks. Monday, we start Saturday morning to the following Friday. 2 weeks. We close it, signals are produced over the weekend, and Monday an execution decision is made. Early last year, we added a mid-cycle signal. We always had the daily data and the weekly data, but for a long time, the bi-weekly was working quite well. So we saw some opportunities to change it, especially with the use of Ravenpack data. So now we've added a mid-cycle signal, which has further enhanced the performance. So again, this is not a trading strategy. This might be a data input in other more complex models with many other variables, but it's a different approach to modeling anticipatory sentiment. So when you roll these all up together, on the left-hand side, these are the comparisons of the blue being the buy and hold since January of 2010, the green being our leading indicator, and then what the actual signal application has been. Someone asked, well, if you started your data in 2006, how far back does it go? Well, we had to collect 4 years of data before we could even begin modeling, 2006 to 2010. We do have charts that start in 2008, and it shows basically the same but better looking charts. But then everybody said, everybody could do well when you're coming off the bottom, so the data is available. And when you look at the cumulative annualized returns, so by using sophisticated and systematic application of our signals, we've consistently been able to improve over even the leading indicator.
Excuse me,
but yeah.
I'm sure. Where is the 17% of the S&P coming from?
That's the cumulative annualized return? Annualized. Okay. We have it broken by year, too. Okay. So this compares the S&P and the signal both by individual year, cumulative, and annualized cumulative. In 2013, we did not beat the buy and hold. Basically, it's like a moving escalator at an airport, versus walking. The time alignment of news and markets was changing, and that's when we went, fully into getting the mid-cycle signals to get them in better synchronization, and that got us back on track. But these are the year-by-year performances. We sent this one of the other bonus features is that, again, when we partition the market into the size of the returns and looking at over on the far right-hand side, again, the signal based on using the indicator, we've now, we're doing, well in the middle market. But what was interesting is that on the signal accuracy, we were capturing 100% of the biggest turns out there, 61% in the middle. Granted that the tails are not as often, but if you look at where the percentage of your turns would be, there's a huge percentage of total returns at these tails if you catch them at the right time. And then we sent the data back off to our friends at Deltax, and we said, this is what we've calculated. Go back, take our leading indicators, take the signals, and come up with the same performance results. And there's some issues of whether you use the Friday close or the Monday open. There is a little slack there where you can lose, 0.75% on your annual return by how you calculate the data. But basically, we've built, I think, a core sentiment measure that, when blended with other composite indicators that are continually variable. We rebuild the signals every week because someone showed earlier, we have our in-sample and out-of-sample history. So every time we get new information, we have to go back and recalibrate it and look for the patterns. So asset managers are interested in how do you apply this to seeking alpha. And the fact is, you can watch how your data is flowing through these various quadrants. Again, behind the scenes, most people say, what do all those bubbles mean? It's basically looking at the direction, the magnitude, and the correlation of sentiment to the S&P. And as one manager said, we're looking for the sweet spot that correlates to performance. We are working on other things, we're looking at a parallel measure of stock market sentiment, social media, linguistic refinements, a daily ticker of this information when we have it fully automated, so you could actually collect sentiment on a daily basis and roll it up to whatever time frame suits you, and then dedicated sectors. My summary is simply this. On the right-hand side, there's a lot of great information out there. Some of it was presented today, whether it's surveys, social media, market prices, but that all of the information that's out there, all aimed at one thing, is how to make a decision. It all originated somewhere in the past. It expanded and changed, and our goal was to capture that information as it emerges, changes, and see how well we can correlate it to what you're looking to do today, tomorrow, and next week. Thank you.
Thank you.